All right. The question says, which statement is true about engagement letters for audits? Let's check each statement. The first one says, the engagement letter identifies the financial reporting framework. That's true. If it's GAAP, IFRS, or some other rules, the letter spells it out so everyone's on the same page. The second one says, the letter describes the objective and scope of the audit. Also true. The objective is my opinion on the financial statements, and the scope is that I'm doing the work in line with auditing standards. Without that, management could later say, wait, I thought you were just doing a review. Nope, it's written right here. The third one says, the letter states that because of inherent limitations, some misstatements might not be detected. That's correct. It's a reminder that even a well-planned audit can't promise perfection. Fraud can be hidden, errors can be subtle, and I can't guarantee I'll catch every single thing. The fourth one says, the letter transfers responsibility for fraud prevention from management to me, the auditor. That's flat out wrong. Management is always responsible for preparing the financials, maintaining controls, and preventing and detecting fraud. That job never shifts to the auditor. So the correct answer is A, 1, 2, and 3 only. Think of the engagement letter like a lease for an apartment. It spells out which rules apply, framework, what you're renting and for how long, objective and scope, and admits that even though the landlord maintains the building, a light bulb might still burn out. But it never says the landlord is suddenly responsible for cleaning your dishes or paying your bills, just like I don't take over management's responsibilities for fraud. And here's your exam day recap. When you see engagement letters, remember this. The letter names the reporting framework, it lays out the audit's objective and scope, and it reminds management of their responsibilities. They make the statements, they run the controls, and they handle fraud prevention. My role as the auditor is to give reasonable assurance, not a guarantee. And the letter makes clear that because of inherent limitations, some misstatements may slip by. It also describes what the report will look like. Independence and ethics are always assumed, but those responsibilities never shift from management over to me. Final answer, A, 1, 2, and 3 only. The question says, which Yellow Book requirement applies uniquely, compared to GAS, to auditors performing financial audits under government auditing standards? Let's walk through it. Option A, communicating significant deficiencies. That's already in GAS, nothing unique here. Option B, ethics principles about public interest and proper use of government information. That's the special Yellow Book ingredient. GAS has ethics too, but Yellow Book adds extra emphasis on serving the public, safeguarding government resources, and avoiding misuse of sensitive information. That's where it sets itself apart. Option C, management representations. GAS already requires that letter, so not unique. Option D, assessing fraud risk. GAS makes me do that too, so also not unique. So the only answer that's truly unique to Yellow Book is option B. Now picture this. GAS is like the regular driver's handbook. It tells you the basics. Obey stop signs, use your turn signals, don't text and drive. Yellow Book is like the government driver's handbook. It has all those same rules, but then it says, oh, and by the way, you're driving a school bus full of taxpayers. You've got to drive in a way that protects the public, keeps their trust, and makes sure nobody's misusing gas money or sneaking off with the bus. That's the difference. GAS covers professional standards. Yellow Book adds this extra ethical layer because you're handling government money and public trust. Final answer, B, ethics principles, including public interest and proper use of government information. The question says, the auditor proposes a significant income tax provision adjustment. Management refuses to record it. Which ethics, professional responsibilities, and general principles communication is most appropriate? First, option A, inform the tax authority directly. That sounds bold, but it's dead wrong. I can't run off to the IRS just because management won't book my adjustment. Confidentiality rules stop me, unless I'm legally compelled through something like a subpoena, so this is a trap answer. Option B, Communicate the uncorrected misstatement and its effect to those charged with governance. This is exactly what I'm supposed to do. If management won't fix the entry, I don't just let it slide. I report it up to the audit committee or the board so they're aware of the misstatement and its impact. That way, governance has the information needed to decide if the financials are acceptable. This is the correct answer. Option C, withdraw immediately. That's way too extreme. Disagreements don't automatically mean I pack up and leave. Withdrawal only comes later if there's a complete breakdown in the relationship or if the financial statements would end up misleading and management refuses to budge. So this one's a classic overreaction trap. Option D, reclassify it to OCI without management's approval. No way. I don't get to override management's financial statements. My role is to audit, not to cook the numbers myself. This is another trap for auditor as management confusion. So the right move is option B. Communicate the uncorrected misstatement and its effect to those charged with governance. And here's the way to picture it. Management is serving dinner. I taste it and say, this stew needs more salt. They say, nope, we're serving it like this. I can't grab the salt shaker and fix it myself. That's option D. I can't storm out of the house over one bland pot. That's option C. And I definitely don't call the health inspector. That's option A. What I do is let the head of the household know, hey, just so you're aware, the stew's under-seasoned. That decision's on them. Final answer, B. Communicate the uncorrected misstatement and its effect to those charged with governance. The question is, a CPA is asked to design controls for a non-issuer client's cash disbursements process and also perform the audit. Which approach best preserves independence under the AICPA code? Option A says, decline the audit and keep the consulting project because it's more profitable. That's not how independence decisions are made. I don't weigh fees and margins. I look at whether I can stay independent. This answer is a total trap, playing on the money angle. Option B says, provide recommendations on control design while management decides, implements, and monitors, and document safeguards. That's exactly what the AICPA code allows. I can consult and recommend, but I cannot take over management's role. As long as management owns the decision and I document safeguards to avoid the management participation threat, my independence is preserved. This one is correct. Option C says, design, implement, and test the controls myself, then just have management sign an acknowledgement. That doesn't work. Management can't just rubber stamp my work. If I design and implement controls, I've taken over their responsibilities. Independence gone. Option D says, perform the audit first, then design and implement the controls after the report date. Nice try, but independence isn't about timing. If I take on management responsibilities at any point in the relationship, it still impairs independence, so this one doesn't solve the problem either. So the best approach is option B. Think of it like teaching someone to drive. I can sit in the passenger seat and give suggestions, but they have to be the one at the wheel. If I grab the wheel and do the driving for them, I've crossed the line. Independence means I advise, they decide. The question is, partner compensation includes a formula that rewards high-fee cross-selling to attest clients. Which firm-level quality response is most effective to address related independence threats? Option A says disclose the formula to the audit committee annually. That sounds transparent, but it doesn't solve the independence problem. The audit committee knowing about the incentive doesn't remove the threat. The conflict is still there. Option B says require pre-approval for any non-attest proposal to an attest client and an independent review of threats and safeguards before offering. That's exactly the right response. It directly manages the self-interest and advocacy threats that come from being paid to cross-sell. By having another layer of independent review and audit committee oversight before the pitch is even made, the firm is actively safeguarding independence. This is the strongest, most effective quality control response. Option C says keep the formula confidential to avoid external pressure. That's the opposite of what you want. Hiding the incentive doesn't reduce the threat, it just hides it. Transparency and safeguards are the key, not secrecy. Option D says allow cross-selling only in the final month of the fiscal year. That's nonsense. Timing doesn't change the fact that incentivized cross-selling creates independence threats. It's like saying, I'll only speed at the end of the road trip. Still speeding. So the correct answer is B. Picture it like refereeing a basketball game. If I'm being paid extra by one team every time I convince them to buy more jerseys, I can't just say, oh, but I'll only pitch jerseys in the fourth quarter, or I'll keep it secret. The only way to keep my credibility is to have a separate official check every jersey deal before I even bring it up. All right, here's the next question. The scenario is, a junior staff posts proposed entries to the client's system just to see the effect and then reverses them without approval. Which principle was most directly violated? The choices are A. Professional competence and due care, B. Confidential client information, C. Integrity and objectivity, D. Scope and nature of services. Option A. Professional competence and due care. This is all about keeping skills sharp and applying them properly. If the staff didn't understand GAAP or messed up basic math, then this principle would be in play. But here, the problem isn't skill, it's crossing a professional boundary, so this isn't the best fit. Option B, confidential client information. That's about leaking client data or misusing it outside the engagement, like selling customer lists or talking about client numbers in public. But nothing was shared here. The issue wasn't exposure of information, it was tinkering with the records, so confidentiality isn't it. Option C, integrity and objectivity. This is the one. Integrity means being honest and straightforward. Objectivity means being fair and avoiding shady behavior. Entering test entries into a live client system without permission, that's tampering. Even if you reverse them, you've broken trust and shown poor judgment. That's exactly what the principle of integrity and objectivity is meant to prevent. Option D, scope and nature of services. This principle is about whether the services you're offering are appropriate, for example, doing bookkeeping and auditing for the same client. That's not what's happening here. This is about how the staff behaved, not the service itself, so this doesn't fit either. So, the best answer is C, integrity and objectivity. Think of it like this. You borrow your friend's credit card just to test if it works, then slip it back into their wallet. You didn't buy anything long-term, and you didn't share the number, but you absolutely broke the trust. Same story here. And here's the quick tip. If you see a question with unauthorized postings or tampering with records, your brain should immediately say integrity and objectivity. All right, let's work through this one. The question is, a government auditee asks the Yellow Book audit team to prepare the financial statements from the trial balance. What step is required by government auditing standards before the team accepts this non-audit service? Choice A, getting a representation from the CFO that they won't review the statements. That doesn't even make sense. The auditor cannot take over management's role, and the CFO must take responsibility for the statements. Having them promise not to review them would actually make things worse, so this one's out. Choice B, documenting the auditor's evaluation of threats, management skills/knowledge, experience, and the safeguards applied. This is the right one. Under the Yellow Book, auditors can sometimes perform non-audit services like preparing financial statements, but only if management has the skills, knowledge, and experience to oversee the work, and the auditor documents both the threats and the safeguards in place. That way, independence isn't compromised. Choice C, having the City Council ratify the engagement by resolution. That might sound official, but Yellow Book doesn't require a City Council resolution. This is just a distractor. Choice D, engaging a second audit firm to perform the non-audit service. Not required. The same firm can prepare the statements as long as they follow the safeguards, so this one's a trap too. So the correct answer is B. Think of it like cooking. The auditor can chop the vegetables, help prepare the statements, but management has to be the one cooking and tasting the dish. And the auditor has to document that management knows what they're doing in the kitchen and that safeguards are in place so the auditor doesn't end up as the head chef. Final answer, B. Document the auditor's evaluation of threats, management skills, knowledge, experience, and the safeguards applied. And here's the quick tip. Whenever you see yellow book questions about non-audit services, look for the answer that mentions documenting threats, management's ability, and safeguards. That's the formula. All right, let's really unpack this one in detail. The question is, a non-issuer client wants the auditor to host their accounting database in the firm's cloud. What's the independence implication? Start with choice A. Hosting the system impairs independence. This is exactly correct. Independence rules are crystal clear. Auditors cannot be the custodians of client records, systems, or data. Why? Because once you're hosting their live accounting database, you're not just an outside referee anymore. You're now inside the client's daily financial operations. You'd be in control of their data, which means if something goes missing or gets changed, you'd be both the keeper and the checker. That destroys independence. Choice B, allowed if the firm uses SOC 2 compliant controls. This is a trap. SOC 2 reports are all about security, availability, and data processing integrity. Great for IT service providers, but irrelevant to the independence rule. Independence doesn't magically appear just because you meet security standards. Even with SOC 2, you'd still be in control of the client's accounting system, which is prohibited. Choice C, permitted if a hosting fee is charged at market rates. This one's sneaky. The exam loves to throw in charge a fee language, but the money doesn't matter. You can't cure a conflict by billing for it. Whether it's free or market rate, hosting the system still puts the auditor in management's role. Choice D, permitted if management signs a responsibility acknowledgement. This is another trap. In some non-audit services, like helping draft financial statements, an acknowledgement works because management retains responsibility and oversight. But hosting the client's database is not the same. In this case, management can't realistically oversee or take responsibility if the auditor is physically running the system. An acknowledgement can't undo the fact that the auditor has custody and control. So the correct answer is A. Hosting impairs independence. Think of it like this. I'm supposed to be grading your homework, not holding your notebook at my house. The moment I keep the notebook, I'm no longer independent. I could add, erase, or lose pages, and then I'd be both the custodian and the grader. That breaks the whole concept of objectivity. And here's the quick tip. Anytime you see auditors hosting, maintaining, or keeping custody of a client's records or systems, don't overthink it. Independence is gone, no matter what safeguards, fees, or certifications are mentioned. All right, let's really open this one up. The question, which statement is true about engagement quality reviews? First, Statement 1. The EQR partner must be independent of the engagement team and evaluate significant judgments. This is true. The whole point of an EQR is to provide an objective, second look at the audit before the opinion goes out. If the reviewer were part of the team, it would just be the same people checking their own work, no safeguard at all. That's why the standards require the EQR partner to be separate from the team and free of conflicts. And their focus is on big-picture, judgment-heavy areas like revenue recognition, estimates, going concern, or anything that could sway the opinion. They're not reperforming all the detail testing, they're reviewing the judgments that drove the conclusions. Now, Statement 2. The EQR may be completed after the audit report release if the team documents why it wasn't feasible earlier. This is false. An EQR is a gatekeeper activity. The review has to be completed and signed off before the report is issued. Otherwise, the safeguard is meaningless. Think about it. What good is a quality review after the opinion is already public? It's like proofreading a press release after it's already been sent to the media. Documentation of why it wasn't feasible doesn't make it acceptable. It just highlights a breakdown in quality control. So when we put this together, only Statement 1 is correct. The right answer is A, 1 only. Let's talk traps here. Choice B, 2 only, is tempting because it tries to use documentation as a fix. The exam loves to throw that in, as if paperwork can cure an independence or timing violation. It can't. Choice C, both 1 and 2, is also a trap because the second statement invalidates it. Choice D, neither 1 nor 2, might trick you if you overthink and assume the exam is pulling a double negative. But remember, Statement 1 is solid and true, so stick with Choice A. Think of it like this.
The EQR is like the final sign-off from a senior chef before a dish leaves the kitchen. The reviewer has to be a different person from the one cooking, and they focus on the important things. Is the dish plated correctly? Is it seasoned right? Is it safe to serve? If the dish already left the kitchen and the customer is eating it, it's way too late for that quality review. And here's the quick tip. Whenever you see EQR on an exam, 1. Independent reviewer, not part of the team. 2. Focuses on significant judgments. 3. Must be done before report release.
Let's break this one down slowly. The question: during planning, the audit team faces confirmation bias when evaluating complex revenue contracts. Which practice best mitigates this bias? Start with choice A. This is the correct one. Confirmation bias means I tend to favor information that agrees with my initial belief while ignoring evidence that challenges it. The best way to counter that is to bring in someone with fresh eyes who wasn't part of the original judgment. A senior not involved in the estimate can challenge assumptions, push the team to look for contradictory evidence, and force consideration of alternative outcomes. That's exactly how you fight confirmation bias. Choice B, increase sample sizes for revenue testing only. This sounds like a strong audit move, but it doesn't really address confirmation bias. Bigger sample sizes might help with detection risk, but bias isn't about quantity of testing, it's about mindset and how evidence is evaluated. Choice C, ask management to write a longer memo on why their estimate is reasonable. That's actually making confirmation worse. You're giving management more space to defend their view, and the team risks anchoring even more on their rationale instead of challenging it. Longer memos don't cure bias, they reinforce it. Choice D, lower performance materiality to create a wider testing net. That changes how much misstatement is tolerable, but again, it doesn't fix the thinking flaw. You can lower thresholds all you want, but if the team is still only looking for confirming evidence, the bias remains. So the best answer is A. Assign a senior not involved in the estimate to challenge key assumptions and seek disconfirming evidence. Think of it like this. Confirmation bias is when I'm convinced my favorite restaurant is the best, so I only read glowing reviews and ignore the one-star ones. The way to break that isn't to eat at the same place more times or ask the restaurant to write a love letter about itself. It's to bring along a friend who doesn't share my bias and will point out the flaws I overlook. And here's the quick tip. If the question is about bias, the answer isn't more testing or longer documentation. It's about changing perspective, fresh eyes, challenge, and looking for disconfirming evidence.